Good evening, everyone. I want to start today by asking you a question. Have you ever made a financial decision only to look back later and wonder, what was I thinking? Maybe you've bought something on impulse, held onto a stock for far too long, or hesitated to invest out of fear. It's not uncommon to feel like your emotions sometimes get in the way of making smart financial choices. But what if I told you that this is not your fault? What if I told you that your brain is actually wired to make decisions based on emotion rather than logic, especially when it comes to money? Welcome to the world of behavioral finance, a field that explores how our brains often lead us to make irrational, emotional, and biased decisions with our money. Behavioral finance blends psychology with traditional finance to explain why we make financial decisions that often don't align with our best interests. Today, we'll take a deep dive into how biases, emotions, and psychological factors affect our money management and how we can harness this knowledge to make smarter, more informed financial decisions. Before we begin, let me encourage you to subscribe to our channel. We're working hard to bring more insightful financial content your way. Now, let's get started with understanding why we make the financial decisions we do. What is behavioral finance? Behavioral finance challenges the classical financial theory, which assumes that investors are rational and always act in their best financial interests. In traditional finance theory, it's assumed that individuals make logical, informed decisions about their investments. The reality, however, is that humans often make decisions based on emotions, biases, and incomplete information. At its core, behavioral finance suggests that human behavior, our emotions, cognitive biases, and psychological tendencies, directly affects financial decisions, causing us to act irrationally. This is why, for instance, investors may panic and sell during market downturns, or make hasty, impulsive decisions when fear or greed overwhelms them. We all know that people can get caught up in the hype of the latest trends, making financial choices that don't align with their long-term goals. Understanding the psychological influences on our financial decisions can empower us to make better choices and improve our financial outcomes over time. Let's now dive into some of the key concepts that define behavioral finance and explore the biases that influence our decisions. Cognitive biases, the brain's shortcuts. Humans are constantly bombarded with information, and our brains have evolved to make quick decisions based on the information at hand. While this allows us to navigate life efficiently, it can also lead us to make financial mistakes. These mental shortcuts, known as cognitive biases, are often at the root of poor financial decisions. Anchoring bias. Let's start with anchoring bias. This is when people rely too heavily on the first piece of information they come across, even when it's irrelevant or misleading. For example, imagine you're shopping for a new laptop. The first one you see costs $2,000. Later, you see another one for $1,500. The second laptop might seem like a great deal, but it may not necessarily be worth that price. You've anchored yourself to the $2,000 price tag, making the $1,500 price seem reasonable, even if it's still overpriced. In the investment world, anchoring happens when people fixate on the price at which they bought a stock. For instance, if an investor purchased a stock at $100 per share, they may be reluctant to sell it when the price drops to $60, even if the fundamentals of the company have changed. This bias prevents individuals from acting rationally and adjusting their strategies based on the current market conditions. Loss aversion. Next, we have loss aversion, a bias that explains why people are more sensitive to losses than to gains of the same size. Studies have shown that losing $100 feels worse than gaining $100 feels good. This emotional response to loss can cause investors to make poor financial decisions. For example, many people hold on to losing investments for too long, hoping the price will rebound to avoid realizing a loss. But in doing so, they often end up locking in losses that could have been avoided by cutting their losses earlier. During market downturns, loss aversion leads to panic selling, where people sell their stocks at the worst possible time, often when prices are low, because they fear further losses. Conversely, this fear of loss may lead them to avoid investing altogether, missing out on long-term growth. Overconfidence. Overconfidence is another common bias, and it's exactly what it sounds like: believing you know more than you actually do. People tend to overestimate their abilities or knowledge in areas like stock picking or market timing, which often leads to risky decisions. Overconfident investors believe they can beat the market, so they engage in excessive trading or try to time the market, neither of which has been proven to lead to better returns in the long run. Overconfidence often leads people to take on more risk than they realize, and it can cause them to ignore warning signs or fail to do proper research. This can be particularly dangerous for investors, especially when they begin to chase quick profits or ignore diversification strategies. The emotional side of financial decisions. Behavioral finance isn't just about biases. Our emotions play a huge role in the decisions we make, too. Fear, greed, and excitement are all powerful emotions that can cloud our judgment and drive us to make irrational choices with our money. Fear and greed. Fear and greed are two of the most powerful emotions in the world of finance, and they are often the driving forces behind market bubbles and crashes. Fear drives people to sell in times of market volatility, locking in losses when the market is low. On the other hand, greed drives people to buy into markets that are overvalued, hoping for quick profits without properly assessing the risks. A great example of this is the dot-com bubble of the late 1990s. As tech stocks surged, investors became greedy and piled into stocks without questioning their true value. When the bubble eventually burst, millions of investors suffered huge losses. Similarly, during the 2008 financial crisis, fear led people to panic, sell their investments, causing even bigger market declines. Greed and fear are both irrational reactions that can prompt us to act without thinking through the consequences. To combat this, we need to develop a mindset that focuses on long-term goals rather than short-term fluctuations. Herd behavior. Herd behavior occurs when individuals make decisions based on the actions of others rather than on their own analysis or rational thinking. Humans are social creatures, and there's a strong desire to fit in with the group. This behavior can be seen in the financial markets during bubbles and panics. When everyone is buying a particular stock, it creates a sense of social proof, making people feel that they should do the same, even if they don't fully understand the investment. During the housing bubble of the early 2000s, people bought homes they couldn't afford simply because everyone else was doing it. This was another example of herd behavior, and when the bubble burst, it left millions of people with homes worth less than they paid for them. Herd behavior is dangerous because it leads to irrational decision-making based on peer pressure rather than sound judgment. It's essential to recognize when herd behavior is influencing your choices and to make decisions based on your own research and analysis. Overcoming behavioral biases and making smarter financial decisions. Now that we've explored some of the biases and emotions that influence our financial decisions, let's talk about how we can overcome them to make smarter, more rational choices. Developing awareness. The first step is awareness. Simply understanding that biases and emotions can affect your decision-making is half the battle. Once you recognize that your brain is prone to certain shortcuts and emotional reactions, you can start to question those impulses before you act. For example, if you notice that you're feeling overly optimistic about a stock, take a step back and ask yourself whether you're being overconfident or if you're ignoring potential risks. By making yourself aware of the biases and emotions that drive your decisions, you can avoid acting on impulse. Creating a long-term financial plan. One of the most effective ways to combat emotional decision-making is to have a clear, long-term financial plan. When you have a roadmap for your financial future, you are less likely to be swayed by market fluctuations or short-term emotions. A good plan should include specific financial goals, such as saving for retirement, paying off debt, or investing for the future. It should also outline how you'll handle setbacks, so you don't panic during market declines. Automating your investments, such as contributing regularly to retirement accounts or setting up automatic savings deposits, can help you stick to your plan, even when emotions are trying to take over. Diversification and risk management. Finally, diversification is another powerful tool for reducing the impact of emotional decision-making. By spreading your investments across different asset classes, industries, and geographies, you can reduce the emotional impact of market fluctuations. When one sector or asset class underperforms, others may be performing well, which helps maintain a more stable portfolio. In conclusion, behavioral finance is a powerful lens through which we can better understand how and why we make financial decisions. By recognizing the psychological biases and emotions that influence our choices, we can begin to make better decisions with our money. Whether it's loss aversion, anchoring, or herd behavior, understanding these biases allows us to mitigate their effects and act with more rationality. Remember, financial success isn't about avoiding mistakes completely. It's about understanding why we make them and learning how to correct them. By developing awareness, creating a long-term plan, and managing risk effectively, we can overcome the psychological pitfalls that often lead to poor financial outcomes. Thank you for joining me today, and I hope this discussion of behavioral finance has inspired you to make more informed, mindful financial decisions. Don't forget to subscribe for more insights on how to build wealth and achieve financial freedom.